Morning everybody and welcome to the Aquila Markets macro update this morning on Friday the 26th of March, and as always before viewing any of our content please check out our terms and conditions at aquilamarkets.com. So much noise as we come into month end. Rebalancing has clearly been going on. We can clearly see that from the way in which equities have been trading. A pause in the reflation trade. Rate bonds have maybe just got a little bit ahead of themselves in terms of the rate situation they were pricing in. Suez Canal is blocked extraordinarily. And obviously we've got these issues around China, North Korea, vaccine nationalism, and all these other themes that we've been talking about. But I think the one thing that we really take away from this week is the growing confidence that central bankers have that they're finally going to create inflation. That was the narrative that came out last week from the Powell after the FOMC, and every single one of the speakers that's come out this week in the US has been more positive, has talked about inflation being maybe transitory, but also maybe saying, you know what, we might have to hike rates a little bit sooner. There's positivity. In the UK, and I made this point last week, the change from February where we're talking about negative rates to now talking about this huge upswing that we could potentially see when we reopen is really striking. And I think even in Europe, you say, okay, there's going to be some issues around vaccination and reopening, but it's delaying the reopening. And of course, the critical difference for central bankers now is this huge amount of fiscal stimulus that's come in. And clearly, it's interesting that if you read the Bank of England statement last week, the MPC specifically references the US stimulus package. So much fiscal stimulus, they've wanted this for so long. But the other thing we wonder, and this is a long-term theme of mine, I've had it for many, many years, that low rates creates an artificial price differential between labour and capital. Capital is very cheap, so labour has no pricing power, and this has caused this the K-shaped recovery, if you like. Perverse incentives have really been allowed to flourish. We see that all the time in some of the extraordinary behaviours that we see in the way in which people spend money and use money. There's too much money in the world and it's just too cheap. And labour has suffered for that, and that has created these huge perverse incentives, the diversion between rich and poor and various other things, and the wealth gap. So we wonder if central bankers are starting to realise this, but not only. They kind of want high rates because it's going to enable them to get out of this low rate QE paradox that they've stuck themselves in. March data could be absolutely massive for the US, starting next week with the payrolls next Friday, also Good Friday, which is an interesting situation because liquidity will be bad. But we just need to be aware of the fact that the US data could come out to be ferociously strong. And if we do, we think we're going to see a resumption of the reflation trade. So we're going to look, that's really what we're going to talk about today. Let's just come and quickly look at the dashboard over the last week. And the point that I want to make that I think is really important is for all of this huge rotation and weakness in equity markets, the VIX is still at 20, but we haven't seen that big spike to the upside. The S&P is basically still up on the month and basically flat on the week now. The dollar index is up 1%. That makes sense, and we still like the dollar to keep rallying. We think the dollar exceptionalism can work. And if we come down and look at FX, we can see that FX vol is starting to melt down a little bit and come softer. Weakness in commodities, but it feels like the real sell-off, the aggressive sell-off in those commodities has been arrested for now. In other words, we wonder if the rebalancing is maybe done, and we're questioning whether we can see the reflation trade really kick on back into April. Again, let's just come and look at the calmness and volatility over the month. Yes, we've seen some ups and downs in some of these different sectors as we like to look at, but let's look on the month. Equal weight S&P, that's the S&P where as opposed to it being a market weight index like the regular S&P, it basically weights every stock in the S&P with the same weighting. It's a measure of breadth. We can see that this outperforms. So there's actually been more breadth. And we're up 3.3% in March, even in a month where we've seen all this rotation. Yes, we know growth has underperformed value, but at the same time, there hasn't been this violent move, apart from this move in China. And we think this is very much due to the Chinese trying to manage the amount of speculation that they have. And they don't want to hike rates to do it because they don't want to push the yuan stronger, which is another reason why we like this dollar China higher. And so we think there's definitely some action going on there to try and take the calm out of that. We're not trading China rates right now. So, radar screen, let's look at what we've done here. We had our downside play in the Russell, and we had our downside play in EEM, that's the emerging market ETF, which is actually really China tech. We've taken profit in both of those now into the month end. What we have added is dollar CNH. And so if you look at the radar screen, we are long dollar yen through long dated calls. We have euro dollar downside on, which we still like. We're still targeting 116, 115 and a half. We have this put spread on that we've had on for ages. We've got the dollar CAD high strikes on, which is really a kind of last vestige of the risk off play. And we've added dollar CNH. So we're long dollars in the radar screen. Notice we don't have any equity exposure right now. And that's because coming into month end, we want to let the market speak. The same for rates too. So let's just look at a few charts today to really talk about this inflation theme. So what is on this chart? So the blue line here is 5-year US inflation break-evens. In other words, the expectation of inflation over 5 years. And we can see it's comfortably up here at 2.5%. This huge rally in break-evens that we've seen since the big lows of last year. But remember something, this white line that we see tracking it so cleanly is core PCE inflation. This is the Fed's preferred measure of inflation, and this is their target, 2%. Well, we can see for the last 5 years they've done a pretty bad job of getting this thing above 2%. We touched it a little bit and then broke back down again. This suggests to us that we could really see this pick up and really break up through 2%. Now, of course, what the Fed has told us that we shouldn't worry about this because this is going to be transitory and we shouldn't be too concerned about this. But what if the Fed says, you know what, actually what they really want are higher rates? The market's really concerned that we get, inflation goes up, rates go up a lot, and the stock market gets bashed down, and the Fed's going to come in and basically try and push rates to ensure that rates don't go up too quickly and push the stock market down. We don't think the Biden administration could care less about the stock market. I don't think they think that's a wealth effect that they are bothered about. The only thing they're going to be bothered about is taxing it. So, because this is clearly part of the change, the enormous change in the narrative of the administrations from the Trump administration to the Biden administration. So the Fed could want higher rates for several reasons. One, it starts to manage this rebalancing of capital versus labour. But two, it gives the Fed a great opportunity to claim victory on the policy of QE. Now, we don't think that's true at all because they've been doing this for so long, they haven't been able to create inflation because our view is that very low rates creates hoarding rather than spending because people think in the nominal, and if they get less money or interest on their cash, they save more. And we've had this view for a long time and expressed this many, many times, as many of our older members will know, and people have listened to us for a long time. But it gives the Fed an out. And we mustn't forget that the Fed really wants an out. So we don't think the Fed is going to be too concerned if we continue to see US rates going up. If they go up very quickly, they might get a little bit scared, but we don't think they're going to be bothered at all. And what does that mean? It means that we could start to see a resumption of this reflation trade much quicker than we think, potentially in April. Because at the end of the day, if you really look at this, people go, it's been a big sell-off in March. It really hasn't. There's been some volatility, but it hasn't been that high. The VIX really hasn't spiked that much. It's been really orderly. We certainly haven't had anything like we saw back here, look, and we come here and look at the market map back in February, March of last year. So what are you likely to see here? Well, I think what you're likely to see here is the following. Oil basically goes sideways. We think oil potentially has found an equilibrium point here. So we think oil can maybe grind up, but it's much more likely to be a nothing trade. The dollar can maybe grind up here. Again, that could be part of the euro story. This is the dollar index, which is 55% euros. Equities grind up maybe. Are they going to explode to the upside? We're not sure. But what the cleanest trade for us is rates. The rate story becomes really, really interesting to us. And so therefore, when we come and look at the FX side, so yes, we're going to look at rates trades and we're going to look at the TLT, which is an old favourite of ours, but on the FX side, we have to think about the winners and the losers. It's not just going to be about buying dollars against everything. That's just not the way the game is going to work. We think you've got to think about who wins in the reflation play and who loses in the reflation play, and it's going to be who potentially is going to see higher rates in that period of time. The US, sterling, and Kiwi and Aussie, probably in that order actually. We think the Kiwi has more potential in the short term than the Aussie. We think the Aussie does have some structural issues. The losers, Euro, Yen, Swiss and CNH, we just do not think that the Chinese want to see a stronger CNH at all. And we've been talking about it repeatedly about how this is basing here. CAD, NOK and Stocky, we don't know. And then obviously we really like this idea here of how yields move FX. Let's look at this old classic here, dollar yen versus 10-year yields, strong correlation. This is why we like dollar yen. We're long those 110 calls into June. We think dollar yen through 110.50 can really motor, as we've been pointing out before, that can really start having a proper go to the top side. So think about the narratives that we're trying to build from a point of view and look at the crosses. So we can see crosses that are going to be interesting here are going to be one such as dollar yen, and the next one, of course, is euro sterling. Right, been a favoured players of ours through February. We really like this trade on the reflation story. on the valuation story, because let's just remember, go all the way back here. Before Brexit, we were trading down in the mid-70s here in euro sterling. Before breaking up, this has been the whole Brexit mess. But this looks like it's trying to continue that break to the downside. So we like the fundamental story here, and we like the technical story in euro sterling. It's a really, really interesting play for us to play the RV game in the crosses on the reflation story. And NASDAQ, that's one we want to look at. Head and shoulders potentially here, breakdown, and there's been no downside resolution here in the NASDAQ. We want to let the market speak here. If it breaks to the upside, there could be some short-term technical opportunities in the NASDAQ back to the top side, or it might break lower just because of this month-end mess still to go through, and we get a buying opportunity lower. We're not sure, and we're not going to try and play that game. Let's let the market speak here in equities, focus on where the theme really works, and the theme is going to work in rates, and look at the FX plays that really look to express that. That's it from us. Have a great weekend, everybody, and let's see how we get on. Take care.